Alrighty, guys, let's go. It's almost time for the big interest rate decision to come out. And then, of course, we're going to have Big Daddy speaking in about 30 minutes. But let's get ready, guys. Let's go with volatility. All right, sorry about that. I had to mute the damn stream in the background, but there we go. Yeah, SPY is like double topping right now, right ahead of this event. It's a pretty big move in the market, and we're at a pretty big price point here. If we end up breaking up above 413, that's going to be a huge explosion, I believe, to the upside here. It looks like, as of right now, the market is starting to kind of trend that way just a little bit to the upside here. So that's good to see. Hey, I appreciate you guys joining up. Smash that like button if you're enjoying us going live again here. It's going to be a good time as we continue on through the day. Keisha says, come daddy PP. Oh my God. I'm probably going to get in trouble for saying that. That's funny, but all right, let's go. All right, I'm going to actually throw out a poll real quick. Will the market move up or down? Go ahead and vote really quick. Let's go ahead and say up, down, and then we have another option for sideways. Let's just say sideways / flat. All right, guys, vote up in that poll. Let's see what we have. Let's see what everybody's looking for. Which way do you think it's going to go? Up, down, sideways, or flat? This is going to be a fun next 30 minutes or so, guys. This is going to be awesome. Of course, whenever Powell speaks, we're not going to be talking too much. We're going to be more of listening, but I will have him side by side here with the stock market. So I'll have SPY and Powell side by side, and I'll be cycling through some of the stocks with SPY and stuff like that as well. So keep that in mind. Man, your guys' memes in the chat are so funny. This guy's drinking Jack Daniels out of the bottle, and the other guy is hitting like joint after joint over here. Is that Wiz Khalifa or something? That's pretty funny. Oh, man. Yeah, let's hope that we get a nice big move to the upside here. I would love to see something like that. We're 2 minutes out here on the decision. So get ready, guys. We are about to have it release. Let's actually maybe get I wonder where the best place to see it's gonna be. Maybe on SPY News on Thinkorswim. Maybe something like this. Have that SPY right here though in the background, of course. Zoom it in. All right, there we go. All right, we're about 1 minute away here. About 50 seconds out, according to Thinkorswim's time. Oh boy, I'm getting worried, guys. I don't know about you guys, but I'm kind of like shaking in my boots over here. Not even that I'm worried. I'm just so anticipated for it. Oh, man. Whew, I'm hoping. Wow, come on, guys. Come on, SPY. Let's go. Let's get up there to the upside. I'm going to need some Jack Daniels, guys. It's funny. Oh, man. I can't believe you guys have posted that. Market pricing in a $3+ move, Brewdog said in the chat here. Let's see what we have. All right, it's time, guys. It's time, and oh my gosh, the volatility's coming in. There we go. Come on, let's get that news going through. See the popular news tab on Discord right quick. There we go. 25 basis points, just like we thought, guys. Right there. They raised their key overnight rate by 25 BPS. There we go. All right, all good there. Love to see that. Hang on, someone's confused. All right, that's huge though, guys. Key overnight rate by 25 BPS. That is huge right there. Wow, and we got the volatility. I thought we were going to start running to the upside, but we didn't. We ended up coming right back to the downside. 3% move coming, Ben says. Let's see what happens. Almost all of you guys so far voted to the upside, which is pretty huge right there. Can't believe you guys all voted up like that, but it's not that bad. It's just, you know, one of those things I'm just like, oh, okay. Wow. 3% move, though. Let's hope. Let's hope. Let's see where we are now. Let's see. 3% move. Didn't even get to 1%. So we better get some better price action. But so far, so good to the upside. And I will say, 25 basis points is probably the best thing to go with. You know, I mean, it's still combating inflation. But then again, it's not too high, especially with all the banking situations being the way that they are right now and everything like that. Of course, that's going to play a role in the economy as well. So I'm happy with 25 basis points. Let's see what happens if maybe there's some more news that comes out as time goes on or something like that. Says in assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of upcoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. And what type of risks might emerge, guys? Just imagine, you know, maybe FRC, maybe something like that going on. You know, we can't even get the ticker. Oh, it's FRCB, isn't it? Is that what they said? Yeah, FRCB. Man, is it something like that? Is it WAL? Another bad bank falling off? I mean, there's going to be a lot of big events going on right now, and there already are, in my opinion, that could be impeding this. So we'll have to see what happens, but that's huge. Definitely prepared to adjust the stance of that policy, though, they're saying. That's good. They say job gains have been robust. Inflation remains elevated. It will continue to reduce the balance sheet as planned. Fed repeats U.S. banking system is sound and resilient. Tighter credit conditions likely to weigh on the economy, hiring, and inflation. Sounds pretty good there, honestly. Go back to that SPY really quick here. On the side, let's get that 5-minute chart. Let's get that 1 minute, actually. I want to see the price action right away. Let's go look at it on the book map. How are we looking here in the short term? Let's really watch it. There's going to be a lot of volatility here, guys. This might be the quickest you ever seen book map move, I think. I mean, you're going to see a lot of movement coming in here. And we might, let's actually scroll out and see if we saw any like huge volume dots as this released. Right here, let's see. Yeah, I mean, there was definitely a lot of volume coming in there at the time. Scroll in a little bit more, though, and watch it very closely here. Maybe we'll get a big pop up or down soon. Hopefully we get a big direction shift. Looks like a lot of volumes coming in, pushing it up right now. Hopefully we keep pushing higher. That would be nice. I'm really hoping we go up like the poll says, guys. 18 total votes. 56% of you guys voted to the upside. Sean voted down, so there we go. A couple of you guys voted down, obviously. 39%. It's actually getting a little bit more mixed now as we go further along. A lot of you guys are voting down now. Pretty cool. And hey, if you guys are enjoying this, smash the like button. Let's go. We have about 25 minutes until Big Daddy Powell comes out here and speaks. I cannot wait to see him. It's going to be awesome. He better hurry the hell up. I hope he's not late. That would suck if he was really late, but it is what it is. I guess we'll just wait around for him. But wow, that's awesome. He better hurry up though. That SPY is starting to fall off a little bit more as we're watching it. Man, come on, Powell. We need a hero out here. Oh yeah, we need a hero, guys. That is for sure. Let's hope to get Powell out here on the Powell printer. Gonna have him side by side with the SPY later, so stick around for that one, guys. Should be nice and fun. Look at all these orders coming in down here around 411.12. Maybe that'll push us to the upside. Got some liquidity down there. That's good. Come on, let's go. Let's go, SPY. Get your ass up there. Start moving. Wow, how are some of the tech stocks? How's Nvidia holding up? Not very good. Apple, Microsoft. Uh-oh, it's not looking good here, guys. Not looking good. How's gold? I'll tell you what, gold looks fire right now. Don't sleep on gold, guys. This might be the trade of the day, is maybe getting into some gold. Wow, I'm gonna have to post this one in Discord. This is huge. Come on, I hope that they hurry up. I hope it keeps going here. Man, I hope that fear really came in tough. I mean, come on, SPY. We gotta move back up. We gotta get back up there or else these stocks are gonna die. Did you guys see the meta news as well? Man, that meta news was insane. Let's go see if we can get the headline on that one up here really, really quick. I mean, that was terrible to see with good old meta today. Let me see if I can find that here. Here it is. They proposed barring Meta from monetizing kids' data. It's pretty big. I mean, that was a pretty bad report, guys. And it said that they've, already paid tons of things for violating people's data and all that type of stuff. So, man, that's just crazy, though, for good old Meta. Wow. Yeah, see, they signal a potential end of the rate hikes as well, which is pretty big. I know that we've been watching these charts here for a while. For anybody who doesn't know, they're actually looking to pause on the next two meetings, and then they're actually going to start moving that overnight rate back down. So, pretty interesting there. Pretty interesting. It's very hard to say right now, though, if the market, is going to be adjusting well to this or if they're going to be upset. Kind of hard there. Wow. Kind of hard to assess this. I think it's actually a good play up. I think that they should be moving up, to be honest. I'm hoping up. Somebody in Discord said they sleep with gold under their pillows. That's funny. Jerry B says, no, Tom, down, down. That's funny. All you guys are starting to vote for down now. That's funny. Holding you to the purple tie. I love that one, Jerry. That's funny. Yeah, I'm really hoping he comes out with the purple tie. If he comes out with purple, I'm gonna explode. That's gonna be funny. Come on, Powell. Purple tie, baby. Bring it out. Hell yeah, purple all the way. Come on, SPY, get up there. I'm really thinking up. I mean, I feel like that them going towards a pause is good. It just depends why, like if they're going towards the pause because the economy sucks ass, I mean, then it's gonna be bad for the market. But if they're going for a pause because they're getting, their goals are starting to work and stuff, then it's gonna be good. So I don't know. It just depends on how Powell really words things here. So far, it's been flat. Looks like a big theta burner right now. I'll be honest, I feel bad for the calls and the puts. I'm glad I didn't play anything specific here ahead of this. That would have been pretty whack right now. I wouldn't know which way to think. Right now, it's really flat. I mean, this flatness is insane. Now, a lot of those big stocks were pointing down earlier, like Apple and Microsoft. They still look kind of bearish, so I don't know. We might be dropping by the looks of these tech stocks, but the SPY itself is just kind of, yeah, it kind of looks. Every time we start to sell off, though, we're coming right back right here. It's just so up and down. I mean, it's a chop fest. Straight up chop. Straight up chop. We're 20 minutes out on Big Daddy Powell, guys. Is 20 minutes out on that. And then we'll be seeing how he is. Seeing what he says, how his tone sounds. Lots of stuff like that. Here, check this out, guys. Check this out real quick.
That are guaranteed, which is
See if we can get this to replay.
You are getting scammed by the Federal Reserve and you don't even know it. In this life, there are 3 things that are guaranteed, which is death, taxes, and the fact that the US dollar is just going to drop in value. We all know this nasty term called inflation, and that's essentially because the government just prints more and more and more money, which makes all existing money less valuable. Some people take this information and profit from it, where others never end up finding out how this system works and have to pay the price for it. Here's the thing. If you own assets like gold or silver or real estate or certain stocks, most of the time you will make money from inflation, because as the government prints more and more money, those assets will actually rise up with inflation. But the people who never end up buying any assets like that just have to pay the price because everything else around them just rises. I mean, go to the grocery store and you tell me how much prices are rising. So the Federal Reserve is scamming you. Don't let them do that. Buy assets and fight inflation.
Isn't Mike just a cutie? Oh no, I'm just kidding. But yeah, it's pretty cool video by Mike there. Edited by yours truly, by the way. So keep that in mind. But yeah, let's have a good time here heading into this this I guess second event of the day with Powell speaking. Not really the first one. We also have Qualcomm earnings and after hours with Fastly and Etsy. Sunrun is also reporting, so those are going to be some pretty big stocks there. Let's see. SPY's still falling off. Let's go look at the GLD, good old gold. Love to see gold in here. Man, gold's awesome. Rick says, wasted day. I know, right? We need something good to come in, Rick. This is just some big flat movement right now. Even gold now went flat. Pretty crazy. Come on now, Big Daddy P. I'm hoping Powell really brings this stuff back to the upside here. Man, it's like my mind says down, but my heart says up. And I'm thinking up here. Come on, Disney. Hold up for me. DraftKings. Some of my babies. Oh, man, DraftKings. Okay. All right, DraftKings. I like it. Let's go, DraftKings. Love DraftKings here. That's awesome. Let's go. Yeah, it's actually a good comeback by them today. Take that any day of the week. RBLX, how are they? They're coming back too. Wow, so yeah, some of the growth stocks, guys. Look at Roblox. I mean, this is actually a great recovery. I know they had that big drop earlier in the week, but maybe they'll recover back up for a quick scalp, maybe like 35.15, something like that. Could be pretty big here. Come on. Volatility will collapse after this event, which should be very good for Purdy's Condors. Yeah, it will. It'll be good for pretty much anything with premium. Now, if the market does end up exploding or something, you know, just keep in mind that, you know, we could see a potential weird move or something like that, where even if volatility goes down, some of those calls, for example, could pop or puts, but it's still going to be pretty good here. I think you're you look pretty good right now, Purdy. You look set in stone for this one. You have a pretty good range there. I like that range. Ooh. Gotta get a drink here, guys. I've been feeling like I'm the auctioneer at the auction house right now. Ah, there we go. But yeah, Powell will be live here. Gonna start in about 15 minutes, so be ready for it. Get ready now. Go get your drinks. Go get a quick snack and get ready for the show. Pop your popcorn. Run to the gas station, get some candy. Get some beers, make a cocktail, whatever floats your fancy. Roll a joint. I don't care what it is. Just get ready for Powell here soon, guys. It's going to be a fun one. Here comes the SPY right back up. Like I said, a freaking chop fest going on. We do need a hero, Manny. We definitely do. And don't you worry. We will be reinforcing our tradition here in just a couple of minutes. It's going to be a fun one. With Big Daddy Powell coming up. Oh boy. Let's see. Let's go ahead and refresh our percentages here. I mean, it's going to show us for the next meeting now. Oh, no, it's not. It's still showing us for the May meeting, but we already know it's 25 basis points, so this should be at 100%. right now, but let's go ahead and switch out to June. Let's see what they're expecting. So look at this. Oh, okay. So oh, hang on, this hasn't updated. So they're expecting it to hold. So they're expecting a pause in June, apparently, on this chart. It screwed me up for a second because it's not updating to the current. Let's refresh this. Maybe we had to refresh it. Nope. It's just not updated yet, but you know, once they update it, it will show that they're going to be pausing in June, just like how this chart showed that. You know, this June, they're looking for a pause there, a pause in July. So, you know, maybe we'll still see a lot of volatility throughout these couple months. It could probably, you know, the market could probably still go up and down in a pretty big way. But maybe towards the end of this year, heading into the holidays, and then heading into 2024, maybe we'll start to see a recovery out of the market. That would be very, very nice. If that happens, as they start to drop rates back down. Hoping that that happens here, but that's kind of my big hope as time goes forward. Oh, I love it, Purdy. That's hilarious. Oh, boy. Oh. These buttons are hilarious, too. I feel like I'm about to faint. Oh, Rallo got the book map opened here. There we go, Ralla. Go back to that SPY. Let's see what we're looking like here. All right, all right. Nothing crazy, crazy. How's Amazon looking here? Wait, what's this? Did I just see news in the Discord that Amazon's coming out with a TikTok competitor? Oh my lord, guys. Watch out. Watch out here. Watch yourselves. This is going to be huge. Wow, is this really happening? AMZN, I gotta see this news. Where is this? Is this in the popular news tab? Where is it? Oh my gosh. Man, Amazon, guys, is blasting right now. This looks awesome. I mean, the SPY's blasting too. Everything's probably blasting, but man, Amazon's looking pretty darn good here. Where is that at? Where's that news? Amazon TikTok. Yeah, let's see this. I gotta see this. Oh my gosh. TikTok competitor. Where is this here? Is this it? Oh, here it is, guys. Wow, here's the news. Wow. This is huge, guys. I didn't even know that came out here today. Jeez, that's great news for Amazon. Go on, Amazon. You guys better keep your eyes on this. Wow. It's called Inspire. I kind of like that. That sounds kind of cool, guys. Inspire. You know, I could end up using something like that. Could be pretty nice. Inspire. I like that. That's pretty cool. Makes sense for Amazon. They directly benefit from the sales. I know, right? Imagine that. They don't even need to pay anybody else for any ads on any other things like, you know, Facebook, Reels, or Instagram, or anything like that. They got their own now. So, wow, that's pretty cool. I'll take it. Hey, but let's smash that like button, guys. We're at 9 likes right now. Let's get those numbers up a little bit. In the words of Matthew McConaughey, these are some rookie numbers, guys. Let's try to get to maybe 20 likes or so. Gonna have the Big Daddy theme song going on here in just a couple of minutes. So whenever that comes on, I hope that hypes you guys up, and maybe we'll get all hyped up here for him coming out. Hopefully he gets us a nice move to the upside, and we get that big power move like we're looking for. That would be beautiful here for the SPY. The SPY has been stuck here on the daily, right around resistance. And let's look at that daily chart, because a lot of people are sleeping on this right now. We're bouncing off all these key trend lines here to the downside on the SPY. This is very key. Now we're bouncing off this lower trend line. I'm wondering if maybe he'll send us down. We'll test this, move back up, or if we're just going to start to break 418 right now. If we start breaking 418, that's going to be a big play, okay? It should be a huge one. Let's actually look on the book map and see. Okay, there's not really a lot of orders there right now, but I think as time goes on today, you'll see it. Some big orders overhead actually at the moment on the book map, but looking back at the market overall, I think it's going to be a big day here. You know, we're either going to start to trend down to test this, or we're going to start blasting. And I have a feeling that we're going to start blasting up maybe. Hopefully Powell starts to say that they're getting close to their goals. That would kind of be what I want to see here. Meta's back in the green too, they're saying here. Let's see. META. Is it? Oh boy. It is actually. Is it? Let's see. Just barely 0.07%. That's pretty good. Pretty good, but it is running into big resistance around 239.50 to 240. So be a little wary of that, but with the market blasting up, it should follow along. It should follow. And look at Amazon there, guys. Another big run to the upside. Big play by them. I really want to go look really quick at the VIX. Good old VIX down here. It's still sitting right on our lower trend line, guys. This is what worries me a little bit with Big Daddy speaking, because if we start to trend down in a big way, we're going to start to blast up and, you know, go back up to test the top of this range again. And you can tell here on the VIX what happens. You know, this is a pretty obvious setup. It's happened so many times in a row now where it's like, oh man, like you would think that this lower level would hold up again here, right where I'm circling. You would think that this might hold again, so just be a little wary of that. That would be one thing thinking down, but like I said, we need the pop. We need a big hero. Smash that like button, guys. Let's go.
It's gonna take a Superman to
All right, guys, it's almost time for the man, the myth, the legend himself, Big Daddy Jerome Powell. He's going to be coming through here, the chairman of the Federal Reserve.
We're doing everything.
What's this? Are they live right now? I don't feel like, no, I feel like that's going to bore everyone to sleep. We don't want to watch that. We want to see Big Daddy out here speaking. That's what we want to see. And here we go, Yahoo. 2 minutes and 25 seconds out here. Be ready, goofball Powell, someone said in that chat. Uh-oh. Don't leave our chat, guys. We will have him live here with the spy, side by side. It's going to be a very fun time here. I'm really looking for a nice move to the upside. That's kind of what we want to see. That's what I'm hoping for anyways. Nice move to the upside. How do I hide this chat? Get out of here. Get out of here, chat. I don't want to see this chat. Can I turn it off? There we go. Perfect. I hit it. There we go. Someone's going to type something in there. It's going to get me in trouble. That's what's going to happen. And yeah, let's go though. Spy at 413. Ben says, hey, I appreciate everybody for joining up. If you're new around here, smash that subscribe button. Let's go. It's going to be a fun day. I go live every single morning around market open, and I sometimes go live during these fun events like this. So let's go. We're going to have a fun day. Man, I'm hoping Big Daddy can turn us around. Come on now, Powell. We're about 1 minute away. Let's go.
Come on, man.
Yeah, come on, man. Let's go. Hurry up. Want you to hurry up here, Powell.
All right, all right, all right.
You better not take too long or else Happy Gilmore is going to get upset.
Today, Junior?
Haha. Oh. I thought he was going to say something. I thought that guy was about to speak. That would have had me laughing. And don't worry, guys. I'm going to get the volume for us all set and square. So it should be all good once we start. Once he speaks, I'll turn it up or whatever we have to do to make it sound perfect. Keep that in mind. Gonna have a very fun time here. Someone's asking me if they should hold Disney calls through earnings. I'm too biased. The close expiration, I'd probably sell it. Man, come on, Big Daddy. It's time now. It's time to go. Let's go. That'd be funny if he's 15 minutes late again, Keisha says. I know, right? When that song comes on, you sing faster. Hurry up, Powell. Let's go. Get us going here, Big Daddy. We need some movement. Yeah, Keisha, that would not be cool. I'd be very upset with him if he did that to us. Let's go back to Amazon, though. That was the stock with the news. Oh, look who it is. He's out.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%, and we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Mr. Chairman, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Go to Victoria.
Hi, Chair Powell. I wanted to ask, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on.
Here comes the pressing questions.
As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. not an assessment that we've made. That would mean we think we've reached that point. And
we're starting to turn over here, guys. Uh-oh, it's not looking good now. Not looking good.
But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting. And that's, we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could. Could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves, why did the committee feel it was necessary to...
This is a really good question.
Well, the reason is that we, again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
Look, I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%?
You know what, let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools.
Yeah, you're right. He is pretty damn boring, isn't he? He sounds like a damn robot sometimes. Like today, he's not very fun. Sometimes he's a lot funner than this.
I think we're gonna need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible
today, Junior.
A mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at, the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that, that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then it's.
Yeah, he was really stuttering there for a second.
That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market. And all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward, is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we're thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in. But that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to. Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory or the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift.
I think he's done after this one, guys.
Less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way: a large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that is, it may just have been
hell yeah, let's go, Sean.
evolving.
30% from the golf course.
Some of it may be our policies and supervisory and regulatory, whatever. what our job is now is identify those things and implement them. And that's kind of the only thing I care about is, and I feel like I am accountable for doing everything I can to make sure that that happens.
Thank you. Evan Reiser with M&I Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, you know, with what you saw in the beige book, and you will see in the SLOOS is small and medium-sized, small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from MarketWatch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for Supervision. Do you think that was the right way to go about this? And yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for Supervision, you know, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall deploy policy recommendations, develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for Supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, you know, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why. And, you know, that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors. And really, in supervision, has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, you know, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, you know, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable, as one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious, too, how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then that we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
Well, it looks like Powell's leaving us and we're going down into the red, guys. This is not good to see at all here. It looks like the SPY is almost double bottoming right now at 409.30. If we break under here, definitely watch for more puts to the downside. I feel like we could see a bigger sell-off, especially out of Meta. Watch Meta support, guys. This support here could be pretty big. I think if they break this, I think that they could really keep going down. They had some bad news come in with the FTC, I believe. Man, apparently they're having a lot of things going on right now where they're not going to be able to sell anybody under 18 can't sell their data. I guess you call them minors. You can't sell any minors data. So that's pretty crazy. Looks like their stock's definitely going down. If you guys are looking for a quick play at the end of the day, I think this could be a good one if we get under like 236.40. Just watch it. I really feel like this could be a good momentum play for all of my scalpers out there. Other than that, I hope I see you guys in the Discord tonight and tomorrow. Let's go. There was a pretty crazy thing with Powell here. Not my favorite. Honestly, he was a bit boring, and he didn't really, reiterate anything too crazy, but he did say some stuff about recessions. Obviously, he said there's possibilities of a mild recession, and I think that, that's him kind of saying, like, hey, that's going to happen because of our policies. We've been tightening for a while, so, I think that's going to start to show more in the economy, and we'll have to see what happens and what they talk about at the next meeting in June. It's June, right? Yeah, on June 14th. So let's get ready, guys. Other than that, have a great rest of your day. I hope to see you in Discord. If you're new here, smash that subscribe button. I go live every single morning at Market Open. I will talk to you guys later.